this chapter 11 is a bunch of other tax credits that are uncommon enough, or there's not as much to say on them that they didn't merit their own chapter. And we'll try to maybe kind of speed run through these. The first one we'll talk about is the premium tax credit, which is if you, this is something to help people pay for their cost of their health insurance, as long as they don't qualify for Medicaid or employer-sponsored coverage. So if you have health care through your employer, then you cannot take the premium tax credit. And the way you get the premium tax credit is you apply for private insurance through the website healthcare.gov, which typically has open enrollment between November 15th and December 15th. Some years they have extended enrollment, but that's the standard enrollment period. And the way this premium credit is figured is it's based on your household income. So household income includes your income plus the income of all of your dependents if they have enough income to be required to file a tax return. So if let's say you have 2 kids and you're head of household, you're going to have to add in your children's permanent fund dividends to your income, because it's more than $1,150. And so that creates a filing requirement for them, so it is included in your household income. Take your household income and we multiply this by a percentage. So a percentage anywhere from 0% to 8.5%. And this percentage is a sliding scale based on your income and where you fall relative to the federal poverty guidelines. So if you're more than, or it might be 8.05%, but if you're more than 4 times the federal poverty guideline, this will be capped out at 8.5%. It goes up, it's not quite linear, it zigs and zags, but your household income times some kind of percentage is your expected annual contribution. And then we divide that by 12 to get a monthly contribution, expected monthly contribution.
So how does it work if you've got pre-retirement parents with like a 30-year-old child, and that 30-year-old child still lives at home but works? Would he severely impact then the household income calculation against or for his parents for their premium if he has his own health care insurance and such anyway, and he's not trying to get it through the plan?
If they're 30 years old, are they going to be your dependent?
Also, just for the dependents?
Yes, just you and your dependents.
So even though the household may have 4 owners?
Yeah, so this will be considered, this is basically based on your tax household, which is your income plus the income of any of your dependents who are required to file a return. So if your 30-year-old is working part-time and they make $3,000 and they don't have a PFD, they're not required to file a return because $3,000 is less than their standard deduction of $3,500. But if they do get a PFD, then you have to count all of their income. So if they work part-time and made, well, $3,000, and the PFD was $1,312, that's still $4,312. So the income is low enough that you can count them as dependent, at least in 2023, because it's gone up to $4,400. But because it's going to be more than their standard deduction, their income will count toward your household income purposes of this credit.
But if they make a average wage or say a couple $1,000s a month and they're in that 20,000 or
Right,
something.
they're not your dependent anymore, so they're not part of your tax
So
household.
even though they're in your house, they don't count for this.
Right,
Okay.
yeah. Your tax household is you and everybody listed as your dependent on your return.
Gotcha. Okay, so if they make over 4,300 or whatever that other dependent credit value is, then at that point you don't even count them for this anyway.
Right. So your tax household income is your AGI plus dependents. AGI. Okay, so we have an expected monthly contribution. And if you go to healthcare.gov, there's maybe a dozen different insurance plans that you could sign up for. And one of them is going to be called the second lowest cost the second lowest cost premium, plan premium. Oh, no, it's the second lowest cost silver plan. So this is basically the middle of the road. It's not a great insurance plan where you have like a $200 deductible and they pay for everything. That would be like a gold or a platinum plan. And it's not like a terrible plan where you have like a $5,000 deductible and they'll only pay 50% even after you meet your deductible. That would be like a bronze plan. So second lowest cost silver plan is going to also be known as the benchmark plan. And it's going to have a monthly premium amount. And the difference between this premium and your expected monthly contribution is your premium tax credit per month. So let's say, for example, maybe I'm head of household with one dependent. And let's say my household income is $45,000. And I'm not going to actually try to figure out what my percentage is going to be. Let's just say it comes to 4%. Maybe is my expected monthly expected contribution. So let's see, 1% is 4,500, 2 is 9,000, 4 is 18,000, or 1,800. $1,800 per year, which comes to $150 per month. Okay, and maybe my benchmark plan comes to $825 per month. So the difference between this, $825 minus $150, is my $675 premium tax credit. And so that's how much the government is willing to help pay toward my insurance. And if I happen to select the second lowest cost silver plan, then my out-of-pocket, my actual cost for that plan is going to be $150 per month. But you can use this same premium to get a more expensive plan or a cheaper plan. I might say, well, let's get a cheaper plan that has that costs $680 a month. I still get to apply this whole $675 toward that. So I might get this cheap plan, it costs me $5 a month for health insurance for me and my kid. Or I might opt for a more expensive plan which maybe is $12.50 per month, but I can still apply the $675 toward that, and I end up paying $675, $575.
With like $100 deductible.
Mm-hmm. Yeah. So I can pick and choose my plan, and the government will kick in $675, up to $675, regardless of what plan I choose. But if I choose one that's actually cheaper than my premium tax credit, so extra cheap plan, then maybe this only costs $585 a month. Well, then I can only apply enough to bring this down to 0.
So you may as well get the one that you may have to pay a couple of dollars, but maximize your value or something.
Yeah. Yep. In this case, you're wasting $90 a month of potential tax benefit. So you could use that extra 90 to get a better plan. Okay, so that's the premium tax credit. But when you sign up, you can, let's say I'm signing up for insurance this month or in November for 2024, which means this premium tax credit is going to be based on information from my 2024 tax return. Well, I'm not going to file my 2024 tax return until a year and a half from now in 2025. So instead, for the advanced premium tax credit, this would be you have to guess. So you have an estimated household income. And then you go through all these calculations, and it's going to come up with an estimated advanced premium tax credit, which means I can use the $675 toward paying my insurance all throughout 2024. But when I finally do my 2024 tax return in 2025, it may turn out that my estimate was bad. Maybe I made more than I thought I would, or I made less than I thought I would. They're going to recalculate, or when we do your tax return, we recalculate your premium tax credit based on your actual income that we know about. When you first sign up, you don't know what your income is going to be. You can estimate that. And let's say after we go through all this, maybe I estimated my income was only going to be $42,000. You know, I didn't anticipate getting a raise or something. So maybe my advanced premium tax credit was $715 because I underestimated my income. So the advanced premium tax credit based on this, and I used it for a regular plan. And it turns out when I filed my tax return, I was retroactively only eligible for $675 out of that $715. So I estimated my income low, and that means on my tax return, I'm going to owe back the $40 times 12, or I'm going to have to pay back $480. And that's going to be counted as an additional tax on my tax return. On the other hand, I may estimate my income high. Let's say I estimate my income is going to be $52,000, but I ended up only making $45,000 because maybe I took a lot of extra time off or got fired partway through the year, or something like that. So if I estimate my income too high, maybe my advanced premium tax credit is $585. And it turns out when I filed my tax return, I really qualified for $675. So that means it's an extra $90 that the government would have paid toward my insurance. So that means I get an extra refund, or technically a refundable credit of 90 times 12, which is 1,080. And that is the premium tax credit and advanced premium tax credit in a nutshell. When you apply for, if you have health insurance through healthcare.gov, you will get a 1095A, is the name of the form that the marketplace sends you, that reports how much you paid for insurance every month and how much your advance payment of the credit was every month. And you have to use that information to fill out Form 8962. So the 1095A comes from healthcare.gov. And you use this information to fill out Form 8962, which reconciles the credit you were actually paid with the credit you actually qualified for. So, because people don't like to owe taxes, it's often a good idea to try to overestimate your income rather than underestimate it. So, just similar to filling out a W-4, just assume the PFD is going to be $3,000 every year, and you'll definitely be over the mark.
What if you thought you were going to make like 50 and you made like 100? You're significantly over.
Right. Yeah. So let me run that as a scenario. So let's say I'm head of household.
We should basically have like a several $1,000 tax bill for your healthcare premium. Yeah, you could. So let's say I estimated $50,000. And then let's say that's going to be 4.5%. I don't know exactly what it's going to be, and I don't feel like looking it up or working it out. $50,000 times 4.5% is going to be $2,250.
yeah, $2,250. So that means $2,250 is my expected annual contribution. And so when I divide that by 12, I get an expected monthly contribution of $187.50. $2,250 per year, $187.50 per month.
Is there a point at which someone doesn't qualify for the healthcare.gov marketplace?
Yeah, when your expected monthly contribution is more than the cost of a second lowest cost silver plan.
Oh, at that point you might be totally on your own.
Yeah. Okay, so this is the numbers that are coming out when I first apply for my health coverage. So let's say for me and one child, my second lowest cost silver plan is $850 per month. We subtract my monthly contribution, expected contribution of $187.50, and my tax credit is going to be $850 minus $662.50. And let's say I just picked the second lowest cost solar plan. So that means I'm paying $187.50 out of pocket. The government's covering the other $662.50.
Is that the second lowest thing for 850? Is that the total for the family, or is that per person?
That's probably total for the family.
Okay.
It's probably a little bit low, but I'll just
So
go with it.
the more kids you have, the more people on the plan, the more potential tax credit from the government you may have
Right.
as well.
Right. If I had 2 children instead of 1, my income would be lower, as it would be the same income, but it would be a smaller fraction or percentage of the poverty line. So this percentage would go down, and this would go up, so my premium tax credit would go way up.
Okay. So if you have high income, hopefully you have a
Yeah.
bunch of kids to offset it.
Yeah. So if I had 2 children, for example, if I had 2 children, this might be, instead of 4.5%, it might be like 2.5%. And 50,000 times 2.5% is, going to be like 1250 or something like that.
Are all the percentages usually in half increments? Or?
No, it's a sliding scale, and it's specifically it goes in 0.01%. So I might have $1250 per year, which would be like $101 per month. And then for me and 2 kids, I might have my second lowest cost solar plan might be $1250 a month, minus 101 would be 1,149 premium tax credit. Okay, so because I have more children, I'm closer to the poverty line with the same $50,000.
What happens when you've got a single income household, but married, filing jointly, and so you got, say, a couple of kids and a wife, and you're the sole provider, but through your work you've got your own insurance.
Then you can't do this.
You can't do this at all.
You can't do this if you're covered by an employer-sponsored healthcare plan.
Well, yeah, but your family may not be. What if you didn't want coverage for them?
Then you can for the family.
Okay.
So maybe your employer only covers you, and you need health care for your spouse and your children. You would go through the same thing, but it would still be a household of 4 people when you determine where this is based on the poverty line.
So even though you've got coverage, you count within that. So if it's 2 kids, like so, husband, wife, and 2 kids in this household of 4, even though one of them already has coverage, it helps in your calculation of the coverage for the others?
Yes, because this percentage comes from a chart where you take your household income, divide that by the poverty limit based on the number of people in your family. So for a family of 2, I believe it's like 19,000 or so. And you come up with a percentage here. So this is going to be about 250%. And we look this number up in the table to come up with what this percentage is supposed to be. And it could be like 4.51% or something like that.
Okay. So if you can get your own coverage and yet do this calculation, then you actually would be better off than probably trying to get everything through your employer plan, or ignoring the employer plan and doing it. And
If your employer offers coverage, you cannot get coverage this way. So if your employer plan says that for a little bit extra we'll cover your spouse and your kids, you have to take that or go without. You can't go on healthcare.gov.
But if your employer plan only covers you, then you have this option.
Yes.
For the rest.
Yes.
Okay.
Okay. But the idea was, let's say I estimated 50,000, and when I actually do my 2024 taxes a year and a half from now, my actual income turned out to be 100,000. And that means it's going to be, I'm going to end up being at a higher percentage for expected contribution. So let's say that's going to be the full 8.5%. And that's pretty easy to figure out. That's $8,500 per year. So this is my advance premium tax credit, which we divide that by 12, we get $708 per month is my expected contribution. And then when I do this 850 minus 708, it's actually what I truly qualified for was only 142 premium tax credit, which means it's called my net premium tax credit is the difference between these. And since my advance is more than what I actually qualify for, I have to pay back the difference. So we take this 662.50 minus the 142, and we come up with 520 per month times 12, which means I have to pay back 7,400.
520 times 12 is 6240.
Oh, 6240. And this counts as an additional tax. So basically I have to pay back 6,240 because I was really bad with my estimate.
Could your tax credits offset this?
Yes. Yeah. So this is one of the only additional taxes that count as part of your regular income tax. So your child tax credit can offset this. And your other non-refundable credits can help offset this too. There is a repayment limitation based on where you fall relative to the federal poverty line. So you might not have to pay that back the whole 6,240. You might be only stuck with paying back 3,000 out of it,
Oh, okay.
or less, depending on.
Are you rarely having to, do people rarely have to pay back the full amount that they underestimate?
Depends on how close you are to the poverty line.
Yeah.
But if say you're between 50 and 100, you're probably nowhere near the poverty line.
Depends on the kid.
Yeah. That repayment limitation exists as long as you're under 4 times the poverty limit. And for a family of 2, the poverty limit is about 19,000. So this is way more than 4 times the poverty limit.
Okay, so you have to pay back a portion or the whole amount?
You have to pay back the whole 6,240 if you're 4 times the poverty line or higher.
Gotcha.
But your income is pretty high and you still qualify for some premium tax credit. You only have to pay 708 instead of the whole 850.
142 times 12, potentially total. Right?
Yeah.
Because this is based on your AGI, right?
Based on your household income,
Right. But
which is your AGI plus your dependent's AGI.
so if you have retirement savings that offsets your AGI,
Mm-hmm.
that you can basically use to reduce your income to get under the 4X level, or
Yes.
where you want to be.
Yes, and that is a clever thing that I did for a particular client because they, back before 2021, if you were over 4 times the poverty line, then you had to pay back the whole premium tax credit regardless of how low you qualify for no premium tax credit at all, which means you have to pay back the whole thing. This was a couple who were in their 50s and their premium tax credit was like 2,000. Their premiums were 2,000 a month, and one of them was a fisherman, and it's hard to predict your income as a fisherman. So it turned out to be more than 4 times the poverty line, and they had to pay back like 24,000, and that was part of their tax, plus self-employment tax plus regular income tax. So their tax bill came out to like 35,000. But they're really close to 4 times the poverty line, and so I said, well, if you could put $5,115 into an IRA, that would bring your AGI down to where you don't have to pay back the full amount. And so instead of 36,000, you only owe like 9,000.
We'll start our retirement.
Yeah.
It's like, have extra IRA.
Even if you don't use it every year, it's a good
Right.
safety net.
Yeah, and if you don't have the money on hand, like if you can borrow it from anyone, $5,115, you can put it into your IRA as a prior year contribution, then you can just withdraw it right back as a current year distribution and give them back the money, and then you still save the $26,000 in tax.
And you can do contributions up until
The due
tax
date.
due date.
Mm-hmm.
And if you extend,
No, it's still the original due date.
okay.
This person came to me first because they had got this 1095A, and they were doing their own taxes on TurboTax, and they said before they put in the 1095A, it said they owed like $8,500 in tax, or $6,500 tax, which seemed reasonable to them. Then they put in the information from the 1095A, and it ballooned up to 36,000, and they said, "Oh, we must be doing something wrong." It's like, no, actually, that is the correct answer. That's how it works. But because I know that we can make adjustments to your adjusted gross income by putting money into an IRA, for example, we can get you a better answer. But they'd come to me in like April 1st, and so I said, you have like 3 days to do this, because April 15th is the deadline. So that if in the next 3 days, find someone who's going to lend you $5,115 for 10 minutes, literally 10 minutes is all. It's like, just lend me the money, I'll put it into my IRA, take it right back out and give it to you.
Oh, really?
Mm-hmm.
You can be that quick of a put in
Yeah.
and out?
You just have to
Yeah.
show the deposit into the IRA slip for that
Yeah.
year.
You deposit it, this was like 2014 or 2015 or something. You deposit it for the previous year, and it counts against your previous year's adjusted gross income. But when you take it out, it counts toward this year's income. So basically what that does is it just pushes off the income, moves income from one year to the next. Yes, you're going to have a 10% penalty. So you are going to actually owe an extra $512 on your next year's tax return.
That's way better than 36,000.
Right. What they actually ended up doing was they sold an extra used car that they had instead of borrowing money. Okay, that was the premium tax credit. There's the 1095A, there's the 8962. And we're gonna speed run these. So we're gonna look at Schedule 3. There's a copy of that on page 349. And the first part is for non-refundable credits. The second part is for refundable credits. And
So what, line 1 through 5 is for
1 through 6.
1 through 6?
1 through 6, including 6A through 6L. So there's about 20 different non-refundable credits that are recorded here, and for about 10 or 11 refundable credits that are listed on this. And there's always a spot for other, because there's so many different things in the tax code that don't all fit on the form. Okay, so our first one is a foreign tax credit. Okay. All you need to know really about the foreign tax credit is that if you pay taxes to a foreign country, you'll get an equivalent credit on your US taxes. And you might end up paying taxes to a foreign country because maybe in your brokerage account you invested in Huawei. And Huawei pays dividends, but it's a Chinese company, so you have to pay Chinese income tax. on those dividends. Or it could be any country, that was just an example. If the total income tax you pay to a foreign country is less than $300, or in a joint return $600, after converting the currency to US dollars, then you can just take a credit for that amount. So my investment in Chinese companies maybe paid me $2,000 in dividends, and I had to pay $400 in taxes to that foreign country. And well, that's over 300. Let's say I got paid $250 in taxes to a foreign country. I can just take a straight $250 tax credit because that's how much I paid. If that amount exceeds 300 or 600 married filing jointly, you have to do a form 1116. I don't know if they have an example of that in the book, but what 1116 does is it figures out what share of US income tax you would pay on the same income. And you get a tax credit for the smaller of what the US taxes would have been on that income or the actual tax you paid. Because different countries will have different tax rates. So for example, if I have pay foreign taxes, not maybe through my brokerage, but maybe I have a rental property that I own in Canada. And maybe my net rental income is $6,000. This $300 limit, you can only use if all of your foreign taxes are reported to you on either 1099s and K1s. If you have foreign taxes you paid just because you have to do a foreign tax return, then you have to use it 1116 regardless, even if it's a small amount. But let's say I have $6,000 in rental income through through the property I own in Canada, and I pay Canada, let's say 15%. I don't know what the actual tax rate is, but I pay $900 to Canada for income tax on that rental income. So that's one limit, is $900 is my actual tax paid. But then I do my taxes and I find out that proportionally it's going to be based on all of my income. Let's say my total income for the year was $50,000. And after my standard deduction of $13,000, that's going to be $37,000, and then my tax on $37,000. It's going to look like $4,235. So my total income, let's just round that off to $4,200. So my total income is $50,000. My tax, my total U.S. tax is $4,200. Actual foreign tax. And I had, what did I say, $6,000 foreign income. Okay, so 4,200 out of 50,000 gives me a kind of what we would call a blended tax rate. So that means I'm effectively paying 8.5% on all of my income, which we apply that same percentage to my foreign income. So my U.S. equivalent tax on that foreign income is $508. So my foreign tax credit is going to be the smaller of those two numbers. So I get a $508 tax credit, even though I paid $900 in foreign taxes.
As you're saying, if the taxes in the foreign country are higher than whatever your tax credit locally would have been, you get as a tax credit.
Right. Yeah.
To offset that, and so ultimately you reduce it by whatever your US taxes would have been on that income.
Right. Yes, so ultimately, you end up paying whichever the two tax rates is higher, either the US tax rate or the foreign tax rate.
So if you have income in both foreign and domestic, that's a way to offset some of your foreign higher taxes by getting a deduction or a reduced amount on your local domestic taxes?
Yeah.
Okay.
Okay. So I paid 15% rate to Canada on my rental property, but in the US I only paid 8.05% or something.
Is that based off of your domestic AGI or your total AGI? Or
This is based on my tax return. You know, I just did a tax return. I took 50,000, I subtracted my standard deduction, and I've plugged the result into the tax table.
does that 50 count for foreign income or not?
Yes. Yeah. This is your total income, including the foreign income, because I have to still report that foreign income.
So that foreign income effectively gets double taxed.
No, it's not double taxed.
No.
This is what this whole thing is about,
It's reducing it.
is
removing the
to
double tax.
eliminate double taxation. So my total tax rate is 8.5% on my US income. So because of that, I get to reduce my taxes by 8.5% of the 6,000. So I'm still being taxed at the same rate, 8.5%. And then the other 6.5% goes, Canada gets to keep that.
Gotcha.
Let's see, if on the other hand, maybe my total income was 250,000, and I take 250,000, subtract my standard deduction, compute my tax based on that, which is, I'm in 35% tax bracket. 250. And my total tax is 56,700 out of 250,000 income. I'm gonna double check that. Yeah. Which is an effective tax rate on all of my income of 22%. I apply that 22% to my foreign income, which was 6,000. So the US part of the tax I'm paying to the US, or would pay to the US based on that $6,000, is $1,360. Well, that means I get to take a credit for what I actually paid, which, because it's less than that tentative tax credit. So the US still gets the excess $460.
Okay.
Okay. So your tax credit is either what you actually paid or whatever tax you would pay to the US based on that same income, whichever is smaller. So I'm not being double taxed. I'm paying that percentage, 22%. I'm paying 22.5 or 22.7%. But part of it's going to Canada and the rest is still going to the US. On the other hand, when it was 50,000, I'm not being double taxed. I'm only being taxed 15%. But it's all going to Canada and none of it to the US. But you end up paying the higher of the two tax rates.
How often do you see this foreign tax credit?
About 100 times a year.
Is that generally people who live there, or?
No. To actually do the full Form 1116, only maybe about 10 times a year. And these are people who generally own foreign property or they may have investment accounts that exceed the $300 or $600 threshold. Out of the 10 to 20 who have to file 1116, the other 80 to 90 are under the 300 threshold, which means you just take a dollar for dollar credit. It's small enough that the IRS doesn't want to make you do all that extra work. Or more likely, the IRS doesn't want to have to review that work.
So if you make like $3,000 while you're somewhere overseas, and you pay $300 in taxes on that income overseas, then you could just take a $300 deduction?
No, it's only if your taxes come from 1099 dividend and K1s. If your only foreign taxes paid are reported on these forms. So we have some clients who work for airlines or air freight companies, and they spend some time in Canada or Singapore or other foreign countries. And if they have to do their Canadian tax first. Actually, the company prepares it for them, the foreign taxes. But we find out how much foreign tax they paid. Maybe they make their salaries maybe $180,000 a year, but they spent 200 days in Canada, so the Canadian part of their salary that's taxable in Canada could be $160,000 out of their $180,000.
Oh, based on where they spend their time?
Yeah. And so we would have to do this foreign tax credit because they might end up paying $20,000 in Canadian taxes, $20,000 US in Canadian taxes, and then we'd have to figure out, well, what would they pay in the US on the same amount? Okay, second, child dependent care expenses, we've already done that. Education credits, we've already done that. So the next new one is retirement savings contribution credit. So this means if you are low income, and the thresholds and the details are pre-printed on the form itself and on page 352. But if you're low income and you manage to save for retirement, then you get a percentage, either 10, 20, or 50%, depending on your filing status and your income, of what you save as a tax credit. So if you put money into an IRA, for example, then not only do you get to deduct that for tax purposes as an adjustment, but you also get a credit of up to 50% of what you put in there, depending on your income. And that 50% is 10, 20, or 50%. That's capped at your first $2,000 in retirement savings. So this credit is capped out at $1,000. It could be 50% of $2,000. And if you put money into a Roth IRA or a designated Roth account through your employer, you'll still get this credit even though there's no deduction for it. And if you put money into a traditional 401k, that's already deducted on your W-2, but you'll have something like a code D with a money amount, and you get a credit in addition.
So it's an incentive for lower income people to save for retirement to get this additional credit for it.
Yeah. One of the, let's see, so if we go to the slideshow, we'll have some information on that. These are your income limits. If you're over these income limits, you cannot take this credit. And one other rule specific to this credit is if you took any money out of any kind of retirement account in the previous 3 years or in the year after, so up to the due date of this return, you have to reduce your contributions by that amount. And it's not like you have to restore it and then you're good. You have to reduce the contributions each year. So if I take, let's say in 2022, I take 4,000 out of my IRA. That means for each of these years, 2023, 2024, and 2025, my first 4,000 in contributions do not count toward my retirement savings credit.
No, that's just the 4,000, that's not 4,000 each year.
Right. So I only took it out once, but that means in every single one of these years, my first 4,000 do not count.
So you would simply alleviate that by putting more in.
Yeah, so if I put 3,000, 3,000, and 3,000 into my retirement savings each of those years, I get no credit because it only counts after the first 4,000.
But if you put in 6 and it's only 50% of the first 2,000 or whatever, then you're still fine by putting in that
Right.
additional in the following years.
Yeah, if I put 6,000, 6,000, and 6,000, I get the maximum credit each of those years.
You don't get a penalty for putting more than so much in there?
Yes, you will, because there's a cap of you can put 6,500, or I think it's 7,000 now, or an extra 1,000. It's 6,000 if you're under 50 and 7,000 if you're 50 or over. And that includes up to the due date of the return. So let's say I saved, let's say we're doing a 2023 tax return, and I saved 3,000, but on April 1st, 2024, I distribute 2,500. Even though this came in a future year, it's before the due date of my 2023 tax return. So that means I only get credit for saving 500.
So if you need to distribute, then you're better off waiting until after April 15th.
Yeah, because after April 15th, this won't count against me for purposes of this credit. Okay, the next one is residential energy credits, and there are two types of residential energy credits. They recently renamed them, so I'm gonna have to look them up more. So the first one is a clean energy credit. And the second one is for energy efficient home improvements. The clean energy credit is, let's see, 30% of what you spend on certain clean energy technologies. That includes solar panels, let's see, solar electric property, solar water heating, qualified fuel cells, so that's like batteries, wind energy, geothermal, heat pump, and other battery storage technology. It's 30% 2022. I think it's starting to phase out, or it might start to phase out in 2024 to where it's like 26% instead of 30%. I'd have to look that up. And it's a non-refundable credit, but there's no limit on the credit. So if I spend $20,000 converting my home to solar and wind electric, then I get a $6,000 tax credit.
So on the efficient home improvement credit,
Mhm.
for exterior doors, do you have to own the home that you put the door in?
Yes. It has to be, both of these credits have to be for a home that you both own and live in. So if you're a landlord and it's for a rental property, those don't count.
So I live in my dad's house
Mhm.
that not technically buying from him, but
Mhm.
it will be mine. Would I be able to use the credit for the exterior door on that?
You have to be the owner. Yeah.
But it sounds like even if you bought it, your dad might be able to.
No, because he doesn't live there.
Oh. So the clean energy, it doesn't actually say how much it is, and this,
It's 30%, no cap, no limit.
oh, okay.
So if I spend, if I spend 100,000 on solar and wind for my my estate, my mansion, I get a $30,000 credit. There's no limit. Other than the fact that it's non-refundable and there's no carryover. So if my tax bill was only 6,000, then it'll reduce my tax to 0, but then I waste the rest.
So have you seen people incrementally keep adding panels to their system?
I haven't seen that. No.
To not,
It's not worth it up here. I mean, in the summertime, if it's sunny, you might get something back from your solar panels or something, but it's not really worth it up here because in the wintertime it just.
No, I don't see much for solar, but I do see quite a bit for biomass fuel property. So that includes like a wood burning, or paper burning, or a garbage burning stove. It has to meet certain efficiency requirements, so it can't just be like something you just built. It has to have certain energy efficiency and retention requirements.
So if I have my dad send a property over to me this year, and I go buy a new wood stove next year and a new front door, I technically use both credits.
Mm-hmm. So this is, okay, so this one is 30%. And remember, all of these that we're talking about here are non-refundable. So 30% and no max. The energy efficient home improvement property is windows, doors, insulation, new roof, and that is basically anything that affects your energy retention or your heat retention or heat shedding properties if you're in a warmer climate, that affects the exterior of the house, also known as the envelope of the house.
so if you paid your neighbor kid like $1,000 to go around and caulk your house, and would you potentially be able to get a tax credit for that?
I don't think so.
Well, let's see.
Because it's basically sealing, creating a tighter envelope.
They all have to, anything that you put in has to meet, all of these will have to meet certain Energy Star requirements.
Okay, so you may not get anything at all.
So you
get
probably,
energy
if you,
rating.
if you pay someone just to redo your caulking, that's probably not gonna help. But if you install a better door, or you have a contractor come and like redo your caulking, and they can certify under certain Energy Star requirements, so it's improving your heat efficiency, then that would count.
Okay, so if you basically just upgrade your appliances that weren't Energy Star to begin with.
No, appliances are not gonna count at all.
No? Okay.
We're
so
talking,
those have Energy Star ratings or whatever.
and then there's also a limit, and it's a very low limit, so it says 30% of certain improvements, but those expenditures are limited to a certain amount. And so the maximum credit is $600. So this one has 30%, max of 600, max $600 credit.
And
And then specific other,
it mentions credit is 1,200 per year. Previously it was 500. Lifetime max credit.
yeah. Are we talking about the 2023 rules?
But there is, I see in here, limits per item somewhat.
Yeah, there's also limits per item, so it's a much less generous credit. I wonder if we have the new 5695.
And these improvements, that could be labor and materials and install and all that.
Yes.
So it's not just the base price of the window, it's window plus install.
Yeah.
So if someone was trying to maximize this with windows alone, they'd really have to do like one window a year.
And you'd have to have a contractor do it so you can get the paperwork that says it was done and how it was done.
Yeah, I think the book is wrong, or maybe they're looking at 2023 rules. I think they are talking about 2023 rules, because in 2022, the limit on windows was 10%. That was $200 credit total. And the annual credit was limited to $500 total.
It is interesting, it's just available for property placed into service after 2022.
Yeah,
So property that you were living in before 2022 doesn't count? Or,
no, it counts on that tax year.
or they're talking about the upgrades or whatever.
Yeah,
improvements.
so you can't claim property that you put in service in 2021 on your 2022 tax return, it has to go on your 2021 tax return. And there were different rules in 2021.
Gotcha.
Okay. All right, so let's see. General business credits, there's about 20 or 30 general business credits that we could take. So we won't go into detail on all of them. There's, for example, there's a tax credit for Social Security tax you pay on employee tips. There's a tax credit for manufacturing, energy efficient appliances. But most of these general business credits we won't have to worry about. If you want to, you can review, you can Google Form 3800 yourself, and you'll see all those credits that are available on that form. Credit for prior year minimum tax, well, we didn't really talk about the alternative minimum tax, but the alternative minimum tax is to ensure that people pay, that have high itemized deductions, pay at least a certain minimum amount of tax. And some of those are exclusion items where you just can't, you're not allowed to deduct certain things for minimum tax purposes. And some of them are deferral items where the timing is different, like depreciation, for example. You can take full 100% bonus depreciation for regular tax, but you have to spread it out for alternative minimum tax. So because of that, if you have deferral items that are creating your alternative minimum tax, you can get credit for that in a future year when the deferral reverses. But that's not really going to apply in most cases. I only mention that because it's on the form and in the book. Next we have credit for the elderly or disabled. We keep mentioning it in the book, and I've still never seen it come up. It's almost mathematically impossible to achieve this credit, so we'll skip over it.
Which one?
The credit for elderly or disabled. The alternative motor vehicle credit is basically credit for hybrid and electric vehicles, or fully electric and hybrid electric vehicles. And that credit was recently renewed, so it's going to be much more popular in 2023 than it has been in 2022 and 2021. But it's a credit of up to $7,500 per vehicle and you can also include used vehicles now, which you didn't used to be able to. And the actual, whether you qualify for the credit or not, depends on how many vehicles that manufacturer has already sold. So they'll give you a certificate, you buy the vehicle saying this is a credit that you qualify for.
I was looking at the used one, and it seems like it's only 30% up to like a small amount maximum. Or basically no, it was like up to like 4,000 for used or something like that. And the value or selling price or something, the price of the vehicle can only be like 25K max, which, you know, most used Teslas are going for like 40.
Right.
Which,
yeah, something like that.
That I didn't, so like you just count the first 25 towards your...
No, I believe if it's over that price, you get no credit.
Oh, really?
Mm-hmm.
I guess that's kind of odd, because then suddenly there's nothing available. So if they're all selling for, 60, 70 new and used 40, which everything used nearly doesn't qualify for it anymore.
Beginning January 1st, 2023, if you buy a qualified used electric vehicle or fuel cell vehicle from a licensed dealer for $25,000 or less, so it has to be 25. So if the sticker price is $26,000, you get 0 credit.
So at that point, to get a credit whatsoever, you pretty much have to buy a new one and, and confirm that it's going to work for the credit based on the certificate from the dealer.
Yes. Okay, so we have the alternative motor vehicle credit and the plug-in vehicle credit. Mortgage interest credit is also very rare. That's a credit you have to apply for before you get your mortgage. So I've never seen anybody get that except for one person in Hawaii out of the thousands of people that I've helped. So that's super rare. Qualified electric vehicle credit. I think these are going to be combined into one new form. District of Columbia first time homebuyer credit, I don't know what that's about. I don't do taxes in DC. Alternative vehicle, fuel vehicle refueling property credit. You also get a tax credit now for installing refueling stations at your home.
Does that count as like the type 2 electric plug?
Mm-hmm.
Does it have to be like a fuel tank for like a...
No, this is for your electric vehicles. Yeah.
Have you seen anybody do propane as an alternative fuel and get tax credits and all that stuff? When I was in Europe, I saw to the point where gas stations oftentimes had a propane setup for filling cars, which I don't know if people set those up themselves.
No, there's no tax credit for, it's only for basically electric and hybrid electric vehicles.
What mentions the fuel cell? I didn't know what that is.
Fuel cell is another word for battery.
Oh.
Like the fuel cell in your gas engine would be your gas tank.
Yeah, no, a fuel cell is a battery,
No, can't be anything else.
no.
It doesn't count as alternative, it's only unusual.
No. So even if it was a biodiesel, that wouldn't count either. This is specifically only for electric and hybrid electric vehicles.
Yeah.
I don't know what this is, so we'll skip that. 8978, that sounds familiar. Well, no, I guess not. Okay. 8978 has something to do with partnerships, we'll skip that. So that's all the non-refundable credits.